Welcome to Mark Arnold's Finance. I recently did a video sharing the most over and undervalued sectors of the stock market. I had one of my subscribers reach out to me and say, how do you determine a stock is undervalued and what makes you buy into a stock? So I thought this would be a great video to share with you guys what I look at before buying a stock. Now, my definition of undervalued is this: buying in at a great price point for a high quality company that should provide me great returns in the future. So I look at a bunch of different things that I'm going to share with you specifically for big things, and then a bunch of other things that I look at. And I think this is going to be a very beneficial video, so be sure to watch it all. And I'm going to be sharing my portfolio performance here in a second. I'm very transparent on this channel and I provide diverse quality content. I'm always growing and learning and sharing that with you guys. So if you appreciate this transparency and hard work, be sure to subscribe to my channel, follow along, see how you like it, and thank you to everyone who has subscribed. I really do appreciate it. So let's get started looking at my portfolio performance. Now, we had the inflation numbers come out higher than expected, so of course that sent the market going down over, I believe, 5% in one day, and I feel it's going to be very choppy the rest of the year until inflation proves to go down over like a 3-month period consecutively. So because of that, I was in the green about 2% not too long ago. Now I'm showing you here I'm down a little over 2%. So I've dipped about 4% total, which isn't bad in my opinion, but I am down $936. So be sure to take a look at this. Anything in purple is the allocation to my portfolio. And then of course what I'm in the red or green in with each company or ETF. So if you have any questions, let me know. I do deep dives into this every so often, but I show it with every video so you can follow my growth or loss. And I'm very transparent. I don't mind sharing when I'm in the red. This is us all learning together, and I don't want to hide a thing from you guys. So let's get started with this video. Now, I'm going to go over 4 main things I look at, and then, like I said, a bunch of other considerations that I look at before deciding to pick a stock. And I think this has saved me a lot of headache and loss in the long term because I've been picking some really good stocks over the last couple years once I started doing this. Before that, I would just jump into buying a stock because of looking at one ratio or going off what somebody else said, but taking the time to do your own research makes a big difference. So I'm going to share with you now the first thing I look at, which is the most popular thing I believe, is the PE ratio. Now that's simply taking the share price and dividing it by the earnings per share. It's also called the price multiple or earnings multiple. So if you hear those, it's all interchangeable. The PE ratio may be estimated on a trailing, meaning backwards looking or past performance basis, or a forward projected basis. Now I tend to use the trailing 12 months when you look, if you've seen my channel, which I'll show you a snippet of it in a little bit, but I use a metrics chart on that. One of the things I show you guys is the PE ratio of a company trailing 12 months. Now, projected wise, going forward, you're depending on a company's projections, which a lot of companies are guilty of providing lower projections, so that way when earnings come up, they beat their estimates. So I just have more solidity going with the trailing 12 months than a projected, but you can use either or maybe a mixture of both. So it's best to take a PE ratio for a company and compare it to its own history, and also compare it to other companies in the same industry and the same sector. This will give you a great idea of where this company is at compared to its history and similar companies in its industry. Now, of course, a high PE ratio could mean the company's overvalued or that investors are expecting high growth rates in the future. So Microsoft is a great example. That company always seems to trade at a premium, a high PE ratio, but that's because investors see this company as high quality, one that efficiently grows its revenues, its earnings, and that it should have no problem with paying at a higher price PE ratio, seeing that they should surpass that someday. So there are reasons why you should still buy into a company that is higher than its industry average or its own history if you really believe this company is going to grow, whatever you're paying for at that point, but it's going to grow even further beyond that. Also, the other side of it, a low PE ratio could mean a company is undervalued. But I will say this, that doesn't mean it's going to be a good investment, because fundamentally the company could be declining. But if it's got a low PE ratio and fundamentally the company's growing, then you have pretty much an undervalued stock that you should consider buying. So companies that have no PE ratio. Sometimes when I'm searching these, I can't find a PE ratio, and usually why is because that company has no earnings. So they're a newer company, or they're losing money, so there's nothing to put in the denominator of that equation to get the PE ratio. So a PE ratio of 18, which means 18 times, means that that company commands a premium 18 times greater than their weighted average earnings. So investors are willing to pay $18 for $1 of current earnings. It's basically what investors expect earnings to grow in the future. So you're betting that, yes, I'm willing to pay 18 times the premium, meaning that you think it'll grow past that, or at least up to that sometime in the future, and your appreciation of your stock price that you buy in today should grow in the future. So a lower PE ratio is a lower price tag, basically. If you're in the grocery store, you're going to be attracted to the lower price tag. But again, that doesn't mean it's a good value, because the fundamentals of that company could be in decline, and you'll be looking at an apparent bargain, but it turns out to be an illusion. You look at AT&T. I bought into that company, one of the first companies I bought into, because it had a low PE ratio and a high dividend payout, but it's done nothing but lose money for me. So that's what I mean by a low PE ratio doesn't necessarily mean a good opportunity. That's the PE ratio. What I'm going to say is, with a few of these that I mentioned today, there's going to be some branches off. And basically any ratio, there's going to be other ratios that do similar but different things. So I just want to mention to you a few of the other things I might look at. One is called the PEG ratio, or PEG, and that's a price to earnings to growth ratio. So you're taking the trailing PE divided by the growth rate of its earnings for a specified time period. So basically, this measures the relationship between the PE ratio and the earnings growth. So you're adding in the earnings growth where the PE ratio doesn't. This allows investors to calculate whether a stock price is overvalued or undervalued by analyzing both today's earnings and the expected growth rate for the company in the future. So you're factoring in the company's growth rate. Now, the PEG ratio can either use historical or projected growth rates. So you want to make sure, wherever you're pulling your data from, which one it's doing, because like I said, I like to go off of the historical. Projected is something I think that's good to look at, but it's more of a guesstimate by the company, and no one can predict the future, so I think it's a little less reliable, but still something good to look at. So typically a PEG of less than 1 is considered undervalued because its price is considered low compared to the company's expected growth earnings, and a PEG greater than 1 is considered overvalued. The stock price is too high compared to the expected earnings growth. So again, I look at the PE ratio, and then I also like to sometimes factor in the PEG ratio to factor in that earnings growth, be it historically or projected, but I prefer the historical. So this is the first thing I like to look at and how I kind of look at it. The next thing I look at is the ROE, or return on equity. And this takes the net income and divides it by the average shareholder's equity. Now, average shareholder's equity is basically your assets minus your liabilities, but I also want to put forth this definition. It says shareholders' equity is the amount that the owners of the company have invested in their business. This includes the money they've directly invested and the accumulation of income the company has earned and that has been reinvested since inception. So shareholders' equity really is, hey, here's some shares so others can buy them, and they'll take that money and then invest it, right? So when I buy shares, that's part of the shareholders' equity. So return on equity is a gauge of a corporation's profitability and how efficiently it generates those profits. So the higher the ROE, the better a company is at converting its equity financing into profit. So equity meaning, the shares that it puts out there for all of us to purchase. Again, always compare these ratios to the peers, right? So similar companies in the same industry, same sector, that will give you a good benchmark to look at. This is also considered the return on net assets because, again, the shareholders' equity is taking assets minus debt. Anything less than 10% is considered poor, and it's recommended that you look for an ROE that is above the average of its peers, but not too high, unless if unless if you can validate a very high, exceptionally high ROE. So an extremely high ROE can be good if net income is large compared to equity. But if it's due to too small of an equity account compared to net income, that equals risk. So that's something you want to look at. If it's extremely high, could raise a red flag and you need to look into it. So some examples of why this might be, having an extremely high ROE is inconsistent profits, excess debt, or negative net income. So if you see that extremely high ROE, look and see if it has one of these three things: inconsistent profits, excess debt, or negative net income. If it does not, then that means it's probably a good thing instead of a bad thing. So I want to look at an ROE example that I found that I thought this was really great to see. Imagine a company with an annual income of 1.8 million and average shareholders' equity of 12 million. The company's ROE would be 15%, or the 1.8 million divided by the 12 million. Now, let's take this real-world example and consider Apple. Their financials for the fiscal year ending September 29, 2018, the company generated $59.5 billion in net income. At the end of the fiscal year, its shareholders' equity was $107.1 billion versus the $134 billion at the beginning. So you'll see here in the equation for the Apple's return on equity, it's 49.4%, and they got that by taking the $59.5 billion divided by the average of the beginning and ending shareholders' equity. So that 107.1 plus the 134 billion divided by 2. So what they did here is what we should all be doing, and what I've been saying: you compare it to its peers. So Apple had a very strong ROE of 49.4%, Amazon's is 28.3%, Microsoft was 19.4%, and Google was 18.6%. So if Apple, having a much higher ROE, which I guarantee it does, has consistent profits, does not have excess debt, and has net income, then this is a great ROE ratio, and one that you should highly consider, because this company is really doing good with its profitability. Like I said, return on equity is one thing I look at. There's two other branches that I want to share with you, two other ratios that branch off from that I also consider. One is ROIC, or return on invested capital. So return on equity, which we just talked about, looks at how well a company uses shareholder equity, while return on invested capital looks at how well a company uses all its available capital to make money. So it's a different way to look at things. The other one I look at is ROCE, which is return on capital employed, and that's just like return on equity, but considers debt and equity. Where return on equity, remember, it's the shareholders' equity, which takes assets minus debt. So the ROCE, return on capital employed, tells you the amount of profit a company is generating per $1 of capital employed. A higher ROCE indicates a stronger profitability. So this helps to understand how well a company is generating profits from its capital as it is put to use. So again, another great tool. The higher the ratio, the better, and it usually shows how efficiently a company is generating profits from its capital. So capital employed is found by subtracting current liabilities from total assets, which ultimately gives you shareholders' equity plus long-term debt. So again, return on equity, return on invested capital, and return on capital employed are three similar but different ratios that I look at, mainly the return on equity, to look at and view my companies before I buy them, and I compare them to my peers. So far PE ratio and then return on equity, and there's a few that branched out between the two. Now, the third one I look at out of the four main ones is debt to assets ratio. I think debt is such an important thing to look at. So the debt to assets ratio is basically the total amount of debt relative to the assets. It's pretty simple. This can reflect how financially stable a company is. The higher the ratio, the higher the risk of investing in that company because it has more debt. There's going to be 2 points at the end of explaining this ratio that are going to be highly important, especially with the times we're in right now. So debt to assets ratio shows the degree to which a company has used debt to finance its assets instead of equity. And this ratio considers all debt. Other ratios will take out certain debt that they feel isn't as important to look at, but this considers all debt, so I like to look at the whole enchilada. If the ratio is 0.4 or 40%, then 40% of its assets are financed by creditors and 60% are financed by shareholders' equity. The debt to assets ratio measures a firm's degree of leverage. Now, debt does have to be repaid, and there's a risk of being forced into bankruptcy by creditors if that debt can't be repaid. So during a recession, which hint hint might be something that we will be going into or we are already in, it's just more something that's a probability, I feel, then if it's during a recession, the higher the debt to assets ratio would mean that it will be hard for that company to stay afloat. Also, again, during these times, a company with a high debt to assets ratio may default on loans if interest rates were to rise suddenly. And what else is happening? Interest rates are rising. So because of a possible recession, the rates rising pretty quickly, this debt to assets ratio is more important than ever. So it's something I highly recommend looking at. Now, the fourth one I look at, which I think is very important, is free cash flow. This is cash a company generates after taking into consideration cash outflows. So basically, it's the money coming in versus the money going out. So it can be a positive or a negative. It's an important measurement that shows how efficiently a company is at generating cash. It shows if a company has enough cash for dividends or share buybacks, which benefits us as the shareholders. The more free cash flow, the better, as it can be used to pay down debt, which is extremely important as we saw, especially during these times, or to pursue opportunities that can enhance its business, so growth opportunities. You look at Meta, they have high free cash flow, and that has allowed them to take this venture into the metaverse. Whether you believe in it or not, that's what free cash flow allows you to do, and it's a great thing. Now, negative free cash flow, though, is not really something that is bad. And if it's money that is being spent in investing in the company's growth, and you feel that it's going to create, good, big returns in the future, then it's not a bad thing that it's negative. So you just have to look at the context and really analyze it and what the company's doing with that, with their cash and why it's negative. So when a firm's share price is low, so now we have, stocks going down, and the free cash flow is on the rise, the odds are good that earnings and share value will be heading up soon. So there's kind of some help for you guys. Now that stock prices have been going down a lot of this year, if their free cash flow is still rising, that means that the share price will most likely rebound pretty quickly. So something to consider. Now, I want to talk about other considerations because I can go into detail for hours, but I don't think that'll do you justice. So other considerations, other things that I look at before I buy a stock. I look to see if their earnings and their revenue has growth, right? If they have a history of growth, and I also look at projections. Are they projecting growth as well? We see a lot of companies changing their outlook to negative. So what companies are keeping positive? I also, want to say this. Ratios usually look at, past information and past performance, but you also need to research the company and see what its business all entails, the whole thing. So one thing is, does the company have a large moat? If it has a large moat, that means there's a less chance that competition will be able to disrupt its business. Is the company going into new business ventures? And are these ventures something that you feel will return dividends to the company long term, meaning it'll be something that'll be profitable? So are they going outside of what they're doing now, and is it a good thing in your opinion? Do they have staying power? I think of a company's ecosystem, right? Apple is the perfect example. Their ecosystem is so sticky. You buy the phone, you buy the watch, you buy the AirPods. They have a lot of subscription services to music, to news, so on and so forth. Once you're in their ecosystem, it's hard to get out. A company like that is gold. So that's another thing I consider. So it's good to look beyond the ratios, beyond the measurements, and look at the big picture and some other things that ratios just can't tell you. So that's a huge thing in my opinion. Now, I do use my metrics chart. So here's the chart. You'll see here a lot of the things I talked about today are in this. These are the things I use in my videos to compare companies. Of course, I factor in other things outside of this, but this is something that I could fit in in a screen and show you guys and provide what I feel is the most valuable information. But what I will say is create your own metrics chart like this. Before you buy something, fill it out, decide what matters most to you, and put it in this chart. So that way you can compare companies, understand what the ratios are that you put in your chart or what information you want to include, and fill it out before you buy a company. So it's easy to be lazy, and a lot of people will just look at a low PE ratio and buy it, like AT&T, and that has just been a big negative for me. Also, do not just go off of someone else telling you, buy the stock because it's cheap. Look into it yourself. You will come to see that a lot of people are just saying things without even doing research themselves. So taking that extra 30 minutes will make the difference, save you the headache, the loss of money, and it just does justice for you. Look at the big picture. I also like to look at if a company has a successful, sticky subscription part of their business. You look at Microsoft, you look at Apple, Amazon. Are these products, these subscription services that people sign up for, is it sticky? Something that someone's going to be a little bit more resistant to canceling even during hard times. That is also gold for us investors in the companies we decide to invest in, because that's predictable, reoccurring revenue that a company can raise its prices on if it's a good, sticky product. So subscriptions are something I look at. Always ask yourself, does this make sense? Fill out your metrics chart, but take a step back and try to take out your biases, right? You want to buy a stock, so you might be trying to put more good spins on it, but take a step back and say, does this make sense? I see some negative things here. Does that make sense? I see some positive things. Does that make sense? Just do a quick analysis, trying to take yourself out of any kind of bias you have in your head, and that's going to do you justice as well. Find reputable sites and gather the data from those sites. And I recommend at least 2, but maybe even 3, because some sites don't update their data very frequently, or it could be incorrect. So it's good to compare between maybe 2 or 3 different sites before you determine that's a pretty solid number or ratio. Make sure that this is a business that you'd be proud to buy their product or use their services. I will tell you this, I bought into Altria, which is a tobacco company. That's not a product I'd be proud to buy. And if you look at it, that's a declining business. That's a declining trend, right? There's less and less people each year that use tobacco. It's what the statistics show. And if I took a step back, right, just to see, does this make sense? I wouldn't have bought into this company. I just bought into it because someone said to, and it had a high dividend. One of my first early mistakes. Luckily, I got out slightly in the green. But does their product add value to customers, right? And will the customers be back to buy those products or use those services over and over again? That's a great sign, meaning it's a very successful business with good products that people will want to use over and over. So these are all the things that I use to determine if a company is undervalued. Again, meaning that it's at a good price point for a high quality company that I feel will return me a lot of money in the future based on where I buy it now. It doesn't mean that it's undervalued based on a PE ratio or something. It's as a whole, right? I look at everything. So I highly encourage you, after this video, make a list. You can use the things I have, but then also maybe find some other stuff, do some research on it, but make a list of the things, maybe 10 things that you will research before you buy a company, right? So it's PE ratio, it's return on equity, it's debt to assets, it's free cash flow. You can even put in the word moat and research. Does this company have a wide moat? And you can put high moat, medium moat, or low moat, right? You can just get creative with it and always fill it out before you buy, because that's going to really help you. It's going to help you avoid some bad decisions. It's going to help you make some good decisions. So let me know what you guys look at that I may have not mentioned, because there are probably thousands of things you can use for measurements. It can make your head spin. So that's why you got to narrow it down to the things you feel are most important, just like I did. So this is what I use to determine if a company is undervalued, or shall I say a good value, meaning it's at a good valuation, a good price point for a high quality company that is going to grow my money massively in the future and help me become wealthy. So with that said, I hope this video added a lot of value to you. I hope it got you guys to see some things that I look at that maybe you haven't. I hope to get some things that you look at that I don't consider. Maybe I'll add and change some things up on my end, because we always got to be willing and open to change, to consider other things and not get stuck in a box. You got to always take yourself out and look at the big picture, get out of your comfort zone. All these things that you put in play are going to make your portfolio stronger and help you make higher returns than you would if you just make lazy decisions, which I am guilty of in the beginning, but I don't do that anymore. I do my research, and it has caused me to say no to certain stocks and absolutely yes to other stocks. So with that said, let me know what you thought of this video. If you appreciate this type of work, I put a lot of work into this. Be sure to subscribe, hit the like button, help support me. I greatly appreciate it. I'm always growing and willing to share all my knowledge with you guys and be as transparent as possible. So again, thank you guys very much. I hope you have a great day, and we'll see you next time on Mark Arnold's Finance.